Hi viewers, today we'll be discussing about debt mutual fund basics. The goal of this series of video is to discuss about the debt mutual fund. Mostly we'll be covering where does the debt mutual fund invests, what are the advantages and why you should invest in debt mutual fund, what are the risks in investing those mutual fund, types of debt mutual fund available in the market, and how will you choose the debt mutual fund. In this first part of video, we'll cover the debt mutual fund and its benefits. In later videos, we will discuss the risk, type of debt mutual fund, and what are the factors you should consider before choosing the debt mutual fund. With that, let's begin our journey into the debt mutual fund. There are two major kinds of mutual funds available in the market. One kind is equity mutual fund and another one is debt mutual fund. Debt mutual funds are popular in the financial market. Debt mutual fund invest in money in different money market instruments like government bonds, treasury bills, corporate bonds, and commercial papers, etc. Debt mutual funds are more popular as they provide a constant return over a period of time with very less risk factor in it. Let's talk about why debt mutual funds are so popular and what are the best advantages of these funds. Debt mutual funds provide stable return over a period of time. It is considered to be less risky than the equity mutual funds. Debt mutual funds are key instrument in constructing a balanced portfolio with moderate risk. According to the investor's risk appetite, people used to put the money into the debt mutual fund. Debt mutual fund are key instrument in constructing a balanced portfolio. As the investor grow in the age, the risk appetite decreases, and the debt mutual fund is an excellent instrument to invest in it. The debt mutual fund provides the indexation benefit for tax filing compared to fixed deposits and recurring deposits. Debt mutual funds are not linked with the market. That's why any movement in the stock market does not affect the debt mutual fund. As the market is driven by sentiments and speculations, equity market always remains volatile. But as the debt mutual fund does not invest in any of the market equities, therefore it is not affected by market movements. If you look at the debt mutual fund, they invest in the corporate bonds, government securities, and treasury bills, which is almost a promised pay at the end of maturity. Hence, the debt mutual funds which invest in bonds and treasury bills get their money without being exposed to a bigger risk. All of this basically indicates the low risk of investment. Next comes the stable return. Debt mutual funds provide stable return over 3 to 5 years period. All the debt mutual funds invest in bond and government securities which periodically provides the return. Usually debt mutual funds which are invested in good bonds and treasury bills are less risky than the debt mutual fund which deploys the money in the junk bonds. The mutual fund which deploys money in unreliable bonds usually gives more return, but it is exposed to the risk. The third part is the tax indexation benefit, and this is a major advantage for having a debt mutual fund. Let's talk about the tax indexation benefit for a mutual fund. We will see scenario 1 dealing with tax without indexation. Think in a vanilla condition, there is no tax indexation benefit. An investor invests money in 2016 with 10,000 rupees. The unit price is 10 rupees and he has bought 1000 units of debt mutual fund. In 2019, the NAV, that is net asset value, of those mutual fund units grows to 20 rupees from 10 rupees. The person sold the mutual fund units with the value of 20,000 rupees. He booked a net profit of 10,000 rupees and he is liable to pay a tax on the net profit of 10,000 rupees. Now let's discuss about the indexation. Let's see how the taxable amount changes with the indexation benefits. In the same scenario, when a person bought 1000 units worth 10 rupees per unit in 2016, he holds the units till 2019. After 3 years, he sold the units at a unit price of 20 rupees and made 20,000 rupees. With indexation, the buying cost of 10,000 rupees in 2016 is not same in 2019. So let's calculate the indexed cost of acquisition in 2019 for those 1000 units of debt mutual fund. So the indexed cost of acquisition will be original cost of acquisition, that is 10,000 rupees, whole into CII, that is cost inflation index of year of sale, that is in 2019 it is 289, and cost indexed inflation for year of purchase, which is 264. So when you divide 289 divided by 264 and multiply into cost of acquisition, which is 10,000 rupees, you will get 10,947 rupees. That means the unit's total bought value in 2016, which was 10,000 rupees, is equivalent to the cost value of 10,947 rupees in 2019. So, hence the net profit is 20,000 rupees minus cost value of 2019 equivalent is 10,987, makes it to 9,553. So that means now the taxable income will be on the 9,053 instead of 10,000, which is without indexation. This CII value, that is cost inflation index value, can be found in the income tax department website, and we will be posting it in the comments where you can find that. The last benefit is that the portfolio diversification. Debt mutual funds provide an excellent opportunity to diversify an investor's portfolio. Usually, an investor of age between 20 to 30 should invest 80% in equity and 20% in debt. While the equity portion gives the growth to his money, the debt portion gives the protection to the money. The investor who are from the age range 30 to 45 should invest 60% in the equity and 40% in the debt, while a senior investor who is aged between 50 to 65 should invest 20% in equity and 80% in debt. With that, we have come to the conclusion of the part 1 of our video. So thank you very much for looking at till the end. If you like the video, please mark a thumbs up and also subscribe to this channel. Put the ring bell so that whenever new videos will be coming out, you will be notified. And share this video with your friends. With that, we'll see you in the next series of the video. Thank you very much.